Current market sentiment is bullish, but only barely. But soon, a sell signal could trigger a selling avalanche, and it would take only a small market drop to trigger something big, a sell signal from the famous Dow Theory. This is important for two reasons. The first is that the Dow Theory has been beating the market for a long time. One academic study from the 1990s calculated the theory's track record over the prior 7 decades, back to when it was created in the early part of last century. And the study found that Dow Theory beat the market by 4.4 percentage points annualized, and that's huge. The second reason to be on your guard for the possibility of a Dow Theory sell signal is that the timing system is widely followed, so a sell signal could generate an avalanche of selling. Among many investment newsletters, few market timing systems are more widely followed. Countless individual traders use it to decide when to build up cash. To get an idea of what such a selling avalanche could look like, consider the mini crash that occurred on February 5th of this year. The Dow dropped nearly 1,000 points in less than 30 minutes during that day's trading, and though the market later in that session recovered some of that plunge, it still ended the day down 1,175 points, its worst point drop in history. Though a Dow Theory sell signal wasn't to blame for the deluge of sell signals that day, many analysts pointed to other timing systems whose trigger levels were breached that day. So let's take a look. Oh, and by the way, this is a trigger fish. The Dow Theory, for those who don't know its history, was created a century ago by William Peter Hamilton, then the editor of the Wall Street Journal. He introduced his theory in stages over several decades in editorials in his newspaper, leaving to generations of followers the task of devising specific rules for what triggers a sell signal. Not all of the Dow theorists agree on every detail. There is broad agreement that a bear market signal won't be triggered until the market jumps over 3 successive hurdles. Number 1, both the Dow Jones Industrial Average and the Dow Jones Transportation Average must undergo a significant decline after hitting new highs, significant both in terms of time and magnitude. This step was hit in the market's greater than 10% correction from the late January highs to the early February lows. Number 2, in their subsequent significant rally following the decline referred to in step 1, either one or both of those Dow averages must fail to surpass their highs. And this step was satisfied in the market's rally attempt through its February 26th recovery high, which, though it was 8% higher than its early February low, failed to take either Dow average above its January highs. And number 3, both averages must then fall below their lows registered at the bottom of the decline referred to in step 1. The levels to watch, therefore, are 23,860.46 points in the case of the Dow Industrials and 10,136.61 for the Dow Transports. Now, notice carefully that the Dow Theory will not catch the exact top of the bull market. Sell signals will always occur several percentage points below that top. This is intentional since Hamilton believed that those several percentage points are an acceptable price to pay in order to avoid getting whipsawed in and out of the market every time there's an extraordinary volatility. The genius of investing is recognizing the direction of the trend, not catching the highs or the lows. So again, the market has already jumped over the first 2 of these steps, and the third and final step requires the Dow Industrials to close below 23,860.46 and the Dow Transports to close below 10,136.61. And that would require a drop of about 0.4% on the part of the Dow Industrials and about 2.1% for the transports. And though the Dow theory traditionally focuses on closing levels for those two Dow averages, you can bet that some investors will jump the gun if it appears as though those averages are about to drop below those requisite levels. But in the meantime, the Dow theory officially remains bullish, and that's because one of the cardinal principles of the theory is that the most recent signal remains in force until it is reversed. And the most recent Dow theory signal was bullish, but this situation could soon change. So let's watch that this week and next week and see what happens. For today, that's Chew Dog Charts. Thank you.